Welcome to the Dividend Talk podcast, episode 97. Our thoughts on the current market conditions. Hey guys, welcome back to another episode of Dividend Talk. Today we're going to talk about earnings of one or two companies and also give our thoughts on the current market. All that and more. See you on the inside. Hey, European DJ, episode 97, all right. We're getting close to the 100.
Oh, yes, that sounds really good. And maybe before we start the show, guys, if you want to join us during episode 100, we are organizing a live show. Look at the description of this podcast, whether it's Spotify or wherever you read it. There's a link to a Google form. Fill it in, and we will send you an invite via Google Meet so that you can join us on the podcast on episode number 100 of Dividend Talk. Let's make it a special one. This podcast has always been for the community and from the community. So I would really love to see you guys. Don't be afraid. Don't be a stranger. Join us if you're curious. And it will be on a Sunday evening, the 22nd of May.
Yeah, I can't wait. I think we did a couple of these before, and it's always a good show. So yeah, please join us. Let's jump on. We have some instead of news this week. We might talk about one or two earnings. So I know you looked at realty income. If you want to start with those.
Well, realty income, what can I say about it? Let's start with the earnings result in itself, bottom line. And funds from operations of approximately $1. I believe the adjusted funds for operations is 98 cents. And the normalized fund from operations is $1 too. So if this would be like 4 quarters like that, we're talking about a $4 per share earnings on an annual basis. You need to know that the share price is currently trading at $66. So we're talking here about a 16 or 17 multiple. Now, for me, what was really nice to see is that realty income is back, right? Because it's really interesting to compare the numbers like the ones with last year. Last year, of course, it was in the midst of COVID after the winter when the pandemic was really, really heavy. So those numbers were all in there. And the numbers therefore look much, much better at the moment. When you analyze the report, it is really back to normal, I would say. And yeah, after the recent declines, you get the stock now at a price to FFO for 16, and we have seen this like around this setting, like I believe one time earlier this year. This has been a bit zigzagging in the whole of 2021 around these prices, but generally it's again around what it was trading also in 2018 and during the midst of the pandemic in the beginning, it was even cheaper. So I'm starting to look at it again. Results were good. The yield is 4.4% at the moment. $66. Probably when it dips below $60, you can consider me a buyer. I love this company. It's for me one of the most iconic companies. If you think about dividend stocks, I think about Johnson & Johnson and Realty Income. Those are the two first stocks that really come to mind. And yeah, they delivered as usual.
Yeah, I could not blame you for thinking of realty income as your top two companies. They don't call themselves the monthly dividend company for no reason. And look, as income investors, that's exactly what you want. They are getting quite attractively priced. I think I would like them to get down maybe to 2018 levels because I'm a little bit greedy. But we'll talk about current market conditions later on in the show, and maybe we'll see what our thoughts will be around stuff like that.
Yeah, and maybe before I forget, there was one little thing that also caught my attention, that they spent almost 800 million in properties in Europe, right? So it
Wow.
doesn't have a large footprint in Europe. So it's really, really interesting to see it. And I wonder how such a company, American company, how is it? Where does it get its knowledge from about the European market, right? I wonder if this is like for them diversification. I don't know, but I will start paying a little bit of attention on this because from the other side, it could also be really a new growth opportunity for years to come for realty income if they nail this.
Yeah, yeah, no, I agree. That's definitely something to keep an eye on.
And I believe you looked at Shell, right?
Yeah, of course, we have to look at Shell, and to be honest, the numbers are pretty much what we said last quarter. Everything we expected happened. Oil prices are quite high at the moment, so we expect a kind of blowout quarter, which is what happened. They've also increased the dividend again by 4%. I think this is the fourth increase since they've cut it. Still well below. I think it's 50% below what it was originally, but they are increasing it as often as they can, and they have got a huge buyback program, which I think was about 8.5 billion for the first half of 2022, and they've purchased back 4 billion of that already. So they are sticking to their plans. But what quite stuck out for me was there was the very first slide on their presentation, and normally they go straight into the numbers, but the very first slide was about accelerating their energy transition. And I suppose they're using the narrative there of what's going on in Ukraine about how not unsustainable, but how unpredictable oil can be and energy resources, and it's really pushing their focus into this. And there's a lot of stuff there that I didn't know. Like for example, they are working with companies for hydrogen. So there's a couple in the UK, and a couple in China as well, which will give them up to about 20 megawatts production capacity, which is quite big. They have got deals done with companies in the US of A, Australia, and pretty much all over the world. So they really are pushing this narrative. Um, it's still unclear how. I mean, you look at the reporting segments, and it's I think 300 million in revenues this quarter, which is absolutely nothing. So it'll be interesting to watch, but they are certainly starting to really push that narrative on investors at the moment. In
Mm.
terms, another thing that I knew about it, but it just kind of reiterated to me was that the net debt this time last year was 71 billion, and now it's 48.5. I mean, that's 22, 23 billion in debt that they paid off over 1 year, which is incredible.
For me, this is the most astonishing number because we're talking here about paying down almost a third of their debt. Their
Yes,
debt was really high after the oil crisis in 2016 and then the pandemic on top of it. Paid down a third.
yes,
Yeah.
and remember they've increased dividends four times in that period, and also bought back 4.5 billion in shares as well. So I mean, overall, it's just incredible what they've done in the
It
last year. Yeah.
yeah. It's a cash machine. I'm looking at the free cash flow numbers over the last 4 quarters, right? We're talking about more than 40 billion in free cash flow.
Yeah, over the course of a year.
Yeah, over the course of a year. I mean, and I really need to applaud you here for buying Shell at 10 euros. I remember your conviction at that time, and I was with you right there
Yeah.
because why I am applauding you, everyone was telling us that oil is dead,
Yes.
won't come back. Yeah, it was all for these shit stocks, and EV is the future. I honestly believe EV is the future, but it gave us a great opportunity because oil is not going anywhere in the next decade. Yes, there might be a peak oil or something like that, but we see it now with all this global instability. Oil is a safe haven.
I mean,
And
planes can't
yeah,
go up into the air without oil. We still need it to heat our homes.
yeah.
It'll be too hard to replace instantly. It will gradually phase out, but even I think that will take 10, 20 years down the line.
hmm and maybe probably not foreseen by management, but their strategy by buying British gas at the time, I believe in 2016 or 2017, was to double down on LNG as a transitionary energy form. Now look with all the the Nord Stream 2 I said cancellation and such. We massively need LNG, and Shell has been warning around that, right? That a boycott of Russian gas, it's not like that the Middle East can simply deliver in a simple manner deliver that, right? So Shell's really a beneficiary here. And I was reading the news today because Shell's also sometimes in the news around energy, and people are complaining that they are making so much profit. And then I wonder, like, where were those? And those are, by the way, not investors, right? Those are the average Joe. And then I think,
Yeah,
like, where was the average Joe when they were making a cash flow loss, when they were cutting the dividend for the shareholders and everything, where all the shareholders felt the pain, and they were with a big smile at the gas station, uh, buying relatively cheap fuel.
yeah,
Yeah, they were not saying let's pay euro more because we want Shell to do well. Yeah, we don't want Shell to have a loss. Yeah, but now they benefit from this. Suddenly they're the bad guys. It just shows like how much I prefer my investor mindset here, EMF.
it's I don't know what it is. Is it a lack of financial education? I don't know, but there's always a tendency to blame the corporations or believe corporations are making more money than what they are. I can't. I haven't ever disclosed where I work, but what I can say is that there is kind of like an attitude out there that they have a lot more money because I've told you what building new buildings, putting new equipment in there, but that's just to stay competitive. Whereas the ordinary person will see this and think, okay, this company has more money, they should be giving me more money. But if you
Yeah,
looked at the balance sheet of the company I work for, you would probably cry and wonder how they're even paying a wage. So it's crazy the mindset, but I mean, it's easy to get carried away in that. We have the luxury, I suppose, of reading and pouring through annual and reports, so we kind of
yeah.
understand where the money goes.
I think it's also an accountability issue that we often have in society.
I think this generation is more entitled, I would say.
Yeah, exactly.
Yeah.
Good. So I mean, there were so many more earnings, right? We haven't spoken about Walters Kluwer that did their job again. DSM, DSM, by the way, is becoming more and more attractive again. I'm really starting to look at some of those stocks, but maybe this is also a nice entry because, I mean, I was really busy at work this week, but there were, I think, 2 days where in the evening logged in on social media, and it was also yesterday evening, I believe, and my feed was all over like, oh, the crash, this, and also these guys from Everything Money started already talking about like a crash would be coming, and I felt like, what? We're just having a down day, yeah. And then, oh, the last time was in 2020 in June or something like that. And I think, like, what is a 3% down day? Yeah, and actually half of my portfolio was even up because I've got a defensive portfolio, right? So it has been really the narrative of the week, and I also started to see fear going into the community. So I'm really happy that we're having this topic here.
Yeah, and I think the fear has started because we've seen some of the big hitters. I think Amazon was down in double digits for the first time
Mhm.
in a long time. And I suppose that's probably where the fear is starting to come in. And people are not used to seeing this. We're used to seeing Amazon burst through earnings and grow and increase 10%. So for Amazon to be down double digits, I think is the real start of fear of big companies like this. Um,
Yeah.
so I'm curious your thoughts of it. So I know I mentioned to you off air that it's been about a 13% drop in the S&P 500 since the start of the year. So we're clearly in a downward trend. Does this affect how you will go about your portfolio? Will you hold off buying, or will you wait, or will you change anything?
Um, yes and no, but let me also share that if you look over the last 5 years in this bull market, 5 years ago the S&P 500 was trading slightly above half of where it is now. Yeah. So what I'm trying to say is like the stock market almost doubled in the last 5 years. So 13% down for me is really, we're really talking about peanuts. Yeah. It was trading 5 years ago around, I don't know, something in the 2000. It got back there twice in 2019, and at the worst of the worst part of the pandemic. And effectively, it almost doubled since then. So, first of all, I'm really grateful that many of my positions in the portfolio went so much up. Yeah, that's first of all, because with that, it was also because of improving earnings. But I do think that there are some things, and this is the thing, right? If you do your homework and read annual reports, nothing comes as a surprise here. It doesn't mean that we predict this, but we see the options. And one of the things, remember Kimberly Clark, when I did a video about that, when was it? Start of 2011, when we read the first quarterly report. What was in there? That inflation is all over the place. Remember that? And
Yeah.
then all the quarterly reports came in that companies were mentioning inflation, inflation, inflation. It was driven by the pandemic, supply chain issues, and such. So now we have a war on top of it. So, and we have further supply chain issues now because Shanghai is closed. We had the Evergreen blocking a whole waterway. Yeah. So if you take this all into consideration, should be no surprise that there is inflation, yeah, high inflation as well, and that the Fed is raising interest rates. And this is one of the narratives that they are doing this, yeah, and that therefore stocks are also starting to cool off. People get scared a little bit. But what I'm trying to say is, like, for me, it's not a surprise what's happening now. And honestly, I put a tweet out earlier. I wouldn't be surprised if the stock drops another 30 or 40 or even to 50%. That's when
Mm.
we are talking about a crash. For me, this is like a correction. And I can't tell you whether it will be a crash or not. I can only tell you that there's some logic in prices getting suppressed and going down at the moment. Yeah. But hey, my portfolio is set up like that, that my dividends are going up. And I think that's really the importance here when you think about it, with what is happening now, EMF.
Yeah, at the moment it is a correction. We're only down, as you said, 13%. Not a whole lot. There's obviously some companies down a lot more, but I suppose the market has changed. As if you look at the characteristics on all these indexes, like S&P 500, the QQQ, for example, the trend is now down. So we are in a downward trend at the moment. That could play out over, I don't know, if it is a bear market, they say it could last, what's the average one? 13 months, I think is the average. It
Hmm.
could be any time, but we could certainly be trending down for a period of time, which I don't think is unexpected given all the things that you mentioned. We've said it before. We expected a crash even
Hmm.
before the pandemic. We expected a
Yeah,
crash.
yeah.
When that happened, I said at the time, I think you agreed that it did rebound too quickly. It wasn't
Hmm.
really, it was like a flash crash, but it wasn't really a crash or there wasn't too much pain because it rebounded too
Yeah.
quickly. But I think
But
now we'll,
also a lot of liquidity came into the
yeah,
system by people that were working from home with high savings rate, money printing, and then also this universal basic incomes, these checks that America was writing to their citizens.
yeah. So I would really discount the COVID as just a kind of a flash crash, whereas now
Yeah.
I think there is clear signs to say that we are in a downward trend. So the question is, how do you protect your portfolio? I mean, everybody's in the stock market. They want to make money, and it's okay to say
So,
hold on to your stocks. But if you look at, say, someone like Intel, which is a
right.
dividend company, which back in 2000 reached a peak that has never reached. It got close. It got close pretty recently, but it never reached the level back in 2000. It dipped. Well, it dipped. It crashed. Stayed flat until about 2014 and started increasing again.
So how I protect my portfolio is protected because I select companies with proper balance sheets, with safe dividends, and an expectation of increasing dividends over time. So I would say that for 90% of my portfolio, I feel totally fine. My portfolio is protected because I'm not so much interested in the share price. I'm only interested at the share price at the moment of buying and the yield that I get for it, and the quality of the dividend behind it. So for me, it's not about protection. I'm totally not thinking about that. I'm thinking about, will this finally be the start of something great that I've been waiting for several years for, that I can snoop up stocks or something like that, as like it would be a candy store. That's what I'm thinking about. The whole defensive part, like, don't even think about that. It even comes to mind this shit like what I had like when I was in my early 20s when I didn't know what I was doing, that you would have like, I said, I remember I had like 150 euros in KPN or something like that. And that was far before I even knew about dividend investing. And that I would put a stop loss. Yeah, stop losses is like horrible. It's invested by investment houses to pull your leg as an investor. But it's all shit for me. So that's how I look at it, EMF. I'm it's not, I don't care so much about the share price. I do care about the dividend growth. Now there might be one or two stocks that might not survive a crash, right?
Yeah.
Where management says like, "Hey, listen up, guys. We prefer to preserve capital another way than paying you dividends." That might happen. We've seen that with Shell. We've seen it with Disney. Yeah, but that's where a diversified portfolio kicks in, which is another way of protection. Yeah,
Yeah.
from that point of view. So yeah, that's my philosophy here. But I'm curious to how you look at that.
Yeah, I mean, I was hoping you were going to say that. I asked the question because it's something that we kind of hear all the time, and lots of people will probably sell and start to panic sell. I'm like you. I'm willing to hold. I don't think my diversification is enough to call it protection at the moment. I don't believe it is because I'm still in the early stages of accumulation. So there are some companies, maybe the likes of Rio Tinto, who I might sell because they're small in my portfolio. But right now, I want to focus on the Johnson and Johnsons, the Microsofts, the Texas Instruments, the core holdings. And I think on the way down, they are the companies I want to be buying. I don't want to be buying Walgreens or turnaround plays.
Exactly,
Even
exactly,
even Intel, my interest on Intel will wane a little bit until I feel that the market is no longer in a downtrend because I think
exactly.
they
Yeah,
will fall. So that's my thoughts on it. I mean, we are income investors, and I think if you look at the top quality companies and just take Johnson& Johnson, for example, and look at their chart, look at their trend, and then look at the S&P 500, you'll see Johnson& Johnson is still in an upward trend, whereas we have a lot more growth stocks and other types of companies dragging down the S&P 500.
And it's good that you say because the S&P 500 is down with 13%, right? My portfolio is still up for the year. I think I'm on, if I don't look at the net buys or something like that, I think I'm up 5 or 6% because ExxonMobil, Chevron, and Shell and
Yeah,
such. Again, this is from a price point of view, right? Good thing. Also, after all the dividend hikes, also my dividend income is up since the beginning of the year. So, I mean, and I get what you mean with protection from a diversification point of view, but do you expect Walgreens, for instance, to cut the dividend? I understand Rio Tinto, but I cannot imagine that you bought Rio Tinto for the dividend growth because um,
no, they are yield. They're high yield.
yeah,
Yeah,
they're high yield, right?
yeah,
But not stable. But you know that over, let's say, the course of 5 6 years, through the boom and bust, you will get a really good return on investment from just the dividends. Yeah.
yeah. But Walgreens are similar in terms of they were a turnaround play. They don't have the most solid balance sheets. So I don't see any reason why they couldn't cut their dividend if they come
Okay,
under
so then
severe
there's
pressure.
yeah, then there's elevated risk there. That's what you're saying.
Exactly.
Yeah,
Compared to the likes of say Johnson and Johnson, it's
yeah.
really my strategy would probably be now just to focus on top quality companies. Companies that, as Warren Buffett said, you can buy if the market's shut for 10 years, I would not mind holding. Walgreens does not fall into that category. It's tier three, tier four at best. So it's
Yeah,
really
exactly.
it's really tier one companies that will probably, so I haven't bought anything this month. And just watching the market and see, but I really want to focus on top quality now.
Yeah. And it's interesting that you say that because I'm just checking quickly in my portfolio, but Shell is my biggest position. Shell's not going to cut the dividend, really not in this inflationary environment. Microsoft, I don't see them cutting the dividend. AbbVie, that's the one with the worst balance sheet, and that's the one that has the most risk here because they do have a shitload of debt on their balance sheet after Allergan. And if they need to refinance that, it will put them more under pressure. Yeah. So that there's a little bit of risk, I would say. ExxonMobil, Same as Shell. And ExxonMobil has also a really strong balance sheet. Ahold Delhaize, I don't see them cutting their dividends. No, I think people will go more avoiding restaurants and go back to the shop if anything. Next position is Apple. I don't see anything there. Next one is Unilever. Unilever, I think the dividend is safe, yeah,
Yeah.
to be fair. But, my thoughts about the CEO. Now, and then let's say position number 9 is Danone. I don't see why the new CEO would do another cut. I think this person was also much more committed to the dividend, and they did an 8% cut. But probably, if I would say, like, and the last one in the top 10, I would say is Johnson and Johnson. So for me, Danone is probably the biggest risk, then AbbVie, then Unilever. Now, and then tell me how much risk that really has in the top 10. And this top 10, for me, is about, let me see, that is half my portfolio.
Yeah. Yeah. My top 10 is quite similar. You could swap out. I have Walgreens in there, and
Mhm.
I think that's the only one that's different. Realty Income. I don't recall you mentioned Realty Income. So I think
It's
they're
not
the
in my top 10. Yeah.
yeah. So they're the only two different that are in my top 10. And I would put Walgreens and AbbVie as the two biggest risks. I would put AbbVie ahead of Danone. I think. I don't think, as you said, the new CEO would do it. We don't know, but I don't think he would. I certainly think AbbVie is a bigger risk at the moment.
Yeah. And then you know that AbbVie is the darling in the dividend investors community, right?
I mean, it is, but you can't ignore the numbers either. I mean,
Exactly.
you can't,
Exactly.
you can't, and you. It's sometimes it's easy to get carried away, and you like you like a company, you get an affinity with them, and you just kind of block out the negative stuff. But the numbers are there. They are going to come under increasing pressure. We know this from next year and the year after. So
Mhm.
there could be an opportunity for them to cut. I don't know if they would, given their long history and their parent company
Yeah.
beforehand, but it is certainly, if they come under enough pressure, they might have no choice.
Yeah. So I don't expect it either, right? But to your point, from a risk point of view, the biggest, and then the rest of my portfolio, the other half is even less than half I'm seeing, is spread around 35 companies. I'm sorry, but I don't really see a lot there. Let's say that my dividend income would be impacted, I don't know, by 2 or 3 dividend cuts. Let's say it would impact the portfolio by 5%. The rest will carry it. Yeah, the rest will probably on average also grow with 5%, and that will be break even. Isn't that a great result in a really strong market crash or something like that?
It would exactly be a good result. But I'm curious as to what you will buy. I know I've said what I will buy, but
Yeah.
what will you start
So
buying?
I would really focus on my tier one companies. To your point, I've been investing a lot in companies in the last year that all have something that is an issue or broken, and then I had to do a lot of analysis to form an opinion whether this is an issue or not, like Intel. Yeah.
Yeah,
Um, but no, for me it would be Johnson and Johnson, um, Pepsi, Texas Instruments, Microsoft. L'Oreal, maybe even, or Siemens, I would like to have more. And this is cyclical. Yeah. T. Rowe Price Group is also cyclical. I would also like to have that one, but it needs to really go lower. But what about Nike? What
yeah,
about Starbucks when it hits in the mid 60s or high 60s? I would really nibble some in there. Uh, Realty Income, Medtronic, Hershey. I mean, Novo Nordisk. Oh, what about Novo Nordisk? Yeah, by the way, it's really fucking expensive right now. But these are the kinds of companies that I'm looking at. And another REIT, Digital Realty Trust, owning half of the, well, probably that's a bit too much. But they own a lot of the real estate for the data centers from Google and such. I mean, aren't these brilliant companies for the long term that you buy at a reasonable price and put them on the shelf?
exactly. And it was funny just before you mentioned Siemens, I was actually typing them in to see the current price, because they're one that I really want as well, and they are close to the 52-week low. I think around
Yeah.
114. Uh, Another 10% drop there, and I'm definitely a buyer for Siemens.
So I did a video about Siemens, I think in December after the annual report, because they published the annual report in December, I believe. And at that time of writing, I think it was trading about 160 euros. And I got comments like, why are you doing this? Yeah, isn't it obvious that it's overvalued? Yes, it's obvious that overvalued, but I did my homework for times like now. My fair value for Siemens was 116 euro. This means taking into account also future cash flow hiccups because of the cyclicality. It's trading now at 114 euros, so technically it's now in fair value zone for me. Um, I would like to probably see still a little bit of a margin of safety, but that's the nice thing. I just go back to my list with all the fair value prices, and I can just look at the margins of safeties. I can quickly see if something has changed to the fundamentals of the stock, and I can just buying. It saves me so much homework soon. I've got my list a little bit already prepared over the last 2 years with all the analysis.
Yeah, yeah, and it's the good thing about doing your homework and knowing what you buy for times like this, because as I said, you want to. I think I think a downtrend and I think a bear market is inevitable. We've had 10, 12 years of a bull market, a really strong bull market at that. So it's only inevitable we're going to get a period where it's not so strong. So I think that's when we focus on quality. But it'll be interesting to see how European companies and
Yeah,
European stocks compare to that. Because remember, this is the SPY we're talking about, which
yeah,
is American. We're not talking about Europe. So we
yeah.
might behave differently to American companies.
hmm Yeah, good point, good point. And but here again, I will be focused on high quality European companies, and we know some of the French ones, right? L'Oreal, Louis Vuitton, so Hermes. But what I'm really wondering, EMF, and I think this is a question that I would love you to answer also for our listeners. What, how do you recognize the difference between a dip, a correction, or a crash? What is it that really that really identifies to you that you know what we are talking about right now?
I mean, a dip to me is when you see maybe companies or even the major indexes that drop maybe 3-5%, and then they continue to rebound back up. If you're looking at a down market, you're looking then at trends. So you're looking at maybe the moving averages. So typically I'd look at maybe the 100 or 200 or 50 week moving averages. Once the market goes below that and continues down, it will retest them. But if it continues down after retest them, it's fair to say that we're going to be in a downward market. A crash is exactly maybe a flash crash is something when it drops 50% in maybe a day or two. You don't even get time to blink. It just crashes straight away. But I don't think this is a crash, so to speak. I just think that we are in a major correction that's going to filter downwards over time until we find some sort of bottom, which may, if it was around 30%, which is what they say is normal, that will be around the 2018 levels, I believe.
Yeah. So I can tell you what how I have learned to recognize a crash. A crash is it starts to with some companies going bust. Let's say hedge funds managers that speculated wrongly, right? And suddenly you start reading in the news that they're
Cathy
going
Woods.
down.
Cathy
No,
Woods.
as an example, that Katie Woods needs to be liquidating her funds, right? Something like that. Yeah, that's typically for me early warnings. But the real one is if when you at a certain moment hear the first companies that they need to start doing layoffs. Yeah, that they say like, guys, we really need to go into cost cutting. Our demand is falling away, so the layoff cycle comes. Yeah,
Yeah.
and then at a certain moment, that and usually that doesn't go overnight. Yeah, that is like I'm talking about a period of months. To your point, is a downward trend, but it's also crashing, and then suddenly at a certain moment there comes an acceleration in the stock market prices because again an event happens. Yeah, like what we saw in 2008, that suddenly the banking system was under stress because the first issues with the first bank, I believe that was already in late 2007, if I recall. I believe, and we saw the bottom of the crash in 2009. So we're
Yeah.
talking here about more than a year, right? But capitulation, when you suddenly watch the news and people just say like, I sold everything. Yeah, it's it's over. These kinds of things. If you hear these awkward stories, and none of this is currently in the news. Nothing, really
N-
nothing.
No, but we're still too early for that, aren't we? Really, like we've
And
just
and,
hit,
and that's why it's
and
not a crash. That's
that's
why
what.
it's a correction.
Yeah, yeah. That's what I said. But I think it will be a major correction. I think we will trend downwards for quite some time. I don't know how long. Maybe till the end of the year, but I think we will definitely see it moving down further this year.
Okay, so let's say you're right, and I give this a high probability, right? Why would you invest money then now or this month for the next 2 months if you are, let's say, convinced that the stock market will be lower a year from now from where it is today? Would you invest any money then this year?
So not every company will go down the same amount,
Hmm.
which we already know. So there is some companies, like I've said, like Walgreens, Intel, that I will not be even looking at in the next while. I will purely put my focus in companies that I want. Some companies that I don't have, like Apple, for example, they
Hmm.
might start coming into a certain range where I want to buy. Johnson will get a lot of my focus at the moment. Um, well, Nike is another one up there that I want to buy. Companies like Striker, maybe some of the
Hmm.
low yielders as well. So these are the companies that I'm going to focus on more. So I will be buying. I might not be buying, putting in extra, because now I'd put in every penny that I have.
Yeah,
I might only put in what I feel. I think I will keep some for a rainy day, but I'm definitely
yeah,
going to change how I'm looking at companies and earnings. I think quarterly earnings will be a little bit more relevant now than they were this time last year for me.
yeah. Okay, interesting. For me, it will be similar. I will just continue to dollar cost average. I still have some money on the sideline, which I would definitely deploy if we're talking about a market crash, not probably during correction, because it would also just, I said, I would probably refill that bucket again under good times, if you know
Yeah.
what I mean. So generally, I will continue to dollar cost average, but I will switch a little bit more to my tier one stocks category to make sure that I strengthen it, because that has been that's been hard of the last 4 or 5 years, because they always felt expensive.
I'm laughing now because I remember I'm getting house renovations done, and it took me
Yeah.
it took me a long time to agree with my wife to do that because we have to use up some cash. And I remember saying to her at the time that I bet you when we spend this money and this cash is gone, the market will crash. And I think I said it to you as well. I
Yeah.
said, I
Yeah,
bet you the
yeah,
market will crash. And look what's happening. I could have wrote a book on this. It's perfect timing.
no, nice. Hey, while we're on this topic, I believe it's also good to go to listeners' questions. And
Yes,
there are
yes.
some listeners' questions that are around this topic. And that's why I want to ask this question, which comes from John Barraclough. He's from our Facebook community. And he has, he has a stock in his portfolio that's just going down. It's IIPR, ticker symbol. I believe this is this cannabis real
Yeah,
estate investment trust. Yeah.
yeah.
He says it's currently 30% down. So his question is, how do you assess if it's time to cut your losses on this one?
So the question I would have is, why did you invest in them in the first place? Why are you investing in them for capital appreciation? If the answer is yes, you probably should have got out before they dropped down 30%. If you're investing in them because they are a safe dividend and that they are going to pay or increase the dividends over the next 10 years, maybe 30% is not such a big deal. I and I think I mentioned that I will be analyzing the companies that I own and deciding if I will sell them based on their dividend safety. That's pretty much what I'll be using.
Yeah, so you will do like what I often do in May, like this year as well. It's kind of I always call it the spring
Yeah,
break cleaning.
yeah.
Yeah, I clean up my portfolio once a year. Yeah,
Yeah, and I have a lot of high yielders in there, which would be more at risk. And then I have a lot, not a lot, but I have got some turnaround companies like Intel
mm,
and Walgreens, which are at risk. So I might decide to sell them and just reevaluate. I don't think they're going to skyrocket in price over the next year anyway. So if
yeah,
the market changes or I change my mind, I can buy them again. No issue.
yeah. Cool. And then Alex, who was not too long ago with us on the podcast, he asked, we mentioned that today as well, that during a meltdown that we will be buying Microsoft and Nike and such. He's mentioning it's not that bad yet, but are there already such companies approaching the buy zone for you?
They are, but I'm sometimes what's the phrase you use? Penny wise, pound foolish. Sometimes I feel
Yes.
like that. I'm just waiting for it to get down to the round numbers. But Microsoft, I think, dropped again to 170. I think.
Mm-hmm.
I need to check
270. Yeah.
270. So they might come into my range pretty soon. The problem is I don't check. I mean, I didn't even know the market was down during the week. I
Mm-hmm.
very rarely check my account. I don't need to. That's why I'm a dividend investor. So
Yeah.
it's good to have this show because I get told about it, and now I can go and check and see what prices companies are at.
Yeah. So I've got three stocks. Starbucks is now trading at $76. My fair value is around 67 to 69. I would love to buy them in the low 60s, but if it hits like, let's say 69, 68, I might initiate a small position. I don't like the debt profile, but I've studied it really a lot, and I've taken that into consideration in my fair value assessment. So that's one. The second one that I would be looking at is Texas Instruments. It's trading now at 167. What is it? 2.75% yield or something like that.
Yeah,
My fair value is $166. I initiated a position, I believe, in February at this price. So I will probably now want to wait until 150. So that's another 10% down. But I would consider that already being in the range. And my third company, so I mentioned Starbucks, I mentioned, I said Texas Instruments, and the third one is, where do I have it here? Um, yeah, ASR. I'm thinking of the insurance company ASR. It's now trading at 42 euro and 27. I would like to have a little bit, probably around 40 euro. I see that also as a high quality company.
cool. Centrino has asked us our question to answer. Do you think we have reached the bottom before new rally, or do you think the best in terms of buying cheaper is still to come?
I have no clue. If you ask me in probability, I think we have not reached the bottom yet. I mean, if I see how the inflation is developing, I think we have not. I was talking with people this week in Poland, specifically in the situation, and I started asking people, guys, what are you doing with a mortgage? And I can tell you, initial feedback is it's really hurting people. I'm expecting to start seeing change in consumer behavior here in Poland. I expect that also in other countries, like in America, where the 30-year rate is exploding as well. So I do believe that we will see in consumer confidence contraction, therefore less earnings for some more cyclical companies. So I just think this ripple effect is still in the really early days here, and I don't think the Fed has tools now to fight it with lower interest rates because inflation is too high. So yeah, I do think there's still much more to come from a probability point of view. Do I know it for sure? Definitely not. It might be that the next show next week is that we are talking about how miracle what a miracle was that the stock market I
Yeah,
said had a bull run.
yeah.
So
And you have to remember, for most of us, this is probably going to be the first time we're in this environment, certainly around inflation. But if we do have a market correction and it goes lower, it's the first time that a lot of us investors will be in it, particularly on Twitter. And we seen when the crash happened in 2020, a lot of people panicked, and we're not seeing, like, we have seen people talk about Amazon, but we're not seeing people panicking yet. So
no, there's
I
no
think
panic at all.
I think when you see a lot more panic, you might start getting closer to the bottom.
I mean, only those people that have those high growth stocks that always said like sky's the limit. And I see Shopify now trading at $400 and not at $1,600. Yeah, well, those people might feel panic, right? Because they were the heroes of 2020 and 21, and now kind of they're licking their wounds and they're quiet. Yeah, but that's the thing. If you don't look at the value, I really believe that value is like a magnet to stock prices. In the end, it goes there. Yeah. So yeah.
Cool. Rep Stones has asked us, are we still using the cover call wheel strategy? I am still using it. Yes, I'm a lot more selective in the companies I use. I'm still stuck with some shy companies like Wish and Solo. I think I have them both of them over a year now, so I'm still stuck with them. But I do it. So I bought an extra 100 shares of Walgreens at 40. It was 41 or 42, and I just selling cover calls. And I think I sold a cover call for 47.5, and they're up. So
Yeah, nice. So I'm not using the wheel strategy really. I'm always selling some put options, but I always do it in such a way that I can buy them maybe with a bit of an additional money added to it, but that I can buy it in a month. So I'm not really how is it? I'm not really putting a lot on put options to generate additional income. I'm just doing it, but I'm doing it really in a risk averse way. So
yeah, yeah,
and to answer his question, I will be more conservative with this now, even more. So I might even stop it at a certain moment because it's for me not my main strategy.
yeah. And I was just about to add just before that as well that I think Interactive Brokers sent an email today. So there's some changes to the margin requirements. So you need to take all that into consideration.
That these fuckers do that every time when there's a stock market crash. They I don't know, they increase the margin requirements from 20 to 25%.
Yeah,
They do this every time. It's like clockwork what they are doing now.
yeah. So I think most of my puts or calls are the expiration date is the 20th of May. So that's next
Yeah.
weekend. So I will definitely be checking what those margin requirements are, and that will have a huge influence on what I do as well.
Mm. Hey, the next question is from Nineyok, and he's asking whether you follow ticker symbol ENB, BIP, or ET. And he's looking at it from an energy sector play point of view.
I don't particularly follow any of them. I know the energy sector is probably the one sector at the moment that is doing a lot better than the market. But I don't own any of these companies or looking at.
So here we're talking, for instance, about Enbridge, right?
Yes, yes.
Enbridge is currently trading in a yield of 6%, which is really, really good, yeah, from that point of view. However, for me, it is trading still near all-time highs from that point of view as well. And yeah, it is an interesting one, but also to be fair, they have only a dividend growth track record of 8%, 8 years. So a strong dividend growth rate over the last 5 years, 10%. But I would say the yield for 6%, I would only consider it for a high yield, but not expecting then too much growth or maybe even anticipating on dividend cut. But in that case, I have Omega Healthcare already with 10% yield almost. So I prefer then the other one over the energy plays. But I like his thinking. But to answer his question, I'm not following them for that reason.
Yep.
Okay, this is a question for you, I guess. Our friend Drip from Kazakhstan, he is asking Liverpool or Real Madrid?
I think that's an easy question, isn't it? It's certainly going to be Liverpool. I hope. I really, really hope.
So if people are from America are listening, there's a Champions League final coming up between EMF's favorite football club from England, Liverpool, and then Real Madrid from Spain. I would really definitely suggest to tune in. These are great matches. Mario is then asking our thoughts about T Rowe Price Group. So I will answer that. I did a video about it not long ago. I said the fair value is around 140 or 150. I don't even remember correctly. Fair value of 170. It's now trading at 125. In my video, I mentioned it could easily go to 100 or below because this company is really cyclical and it earns its money via the assets under management and the fee on it. What we have seen is a capital outflow this week out of the market, which means that they will earn less fees. You need to be aware of this. So if you believe that the stock market will be suffering more and people will be pulling out money or not investing so much money going forward, then expect lower prices. From a dividend safety point of view, I think it is one of the safest dividends out there. They have effectively no debt on the balance sheet. Yeah. So because they know they are cyclical. So I think it's an awesome company. I bought some at 140 or something like that. I'm not needing to buy now, but 125. But I think I will really buy more around 100. That's kind of the anchoring price I have in my mind right now.
Yes. Okay. Dividend Haley asked us, what is the best material stock to hold for life?
Um, This is the one that I own already. For me, it's BHP. Yeah, BHP Billiton. It's a mining company from Australia. Went also a bit into oil, I think, with buying, was it Wood something, Woodside, I believe.
Okay.
Yeah, they own one of the best mines in the world, and they have been making me wealthy with their dividends. Yeah, they have dividend cuts from time to time, like Rio Tinto. I would say if you have them both, you own effectively almost the whole world in mining. So yeah. How about
Okay.
you? What do you think?
It's hard to pick one for life because it's so cyclical in nature, but I don't know. Linde, is it Linde PLC was one I was looking at. It's a
Mhm.
chemical company founded in Germany, so they would be a company I would look at. But if you were to say the whole for life, I don't know. I don't know who I would pick.
Yeah,
I don't think I could pick any of them for life.
super. Hey, then the last question is from Mike and Lou, and he's asking. He really likes to read about companies and their operations, but he finds the valuation part tricky. He would like to hear our take on dollar cost averaging into the best of breed companies over time. For instance, just buy G&G every 3 months or so.
Yeah, I hear you because I would view my valuation skills as mediocre at best. I have bought a couple of books about valuation. I've yet to read them, so I feel this a lot because I've gone through different phases. Do you use ratios? Do you use DCFs or discount models? I don't think it's a bad idea if you want to buy it every 3 months. But you're going to get some highs, you get some lows, but I don't see anything wrong with that
If
strategy.
this would be the case, I would follow a slightly different approach. I would just go to trading 212 as a broker, make your own pie, put a lot of those companies in there, but at least make like these high quality companies, but try to get an average yield of 3% or something like that. Yeah, and let's say take 10 stocks, Johnson Johnson, I don't know, Unilever, Microsoft, throw some of them in there, a high yielder like British Tobacco, and try to get it on average from 3%, because then you know that all those companies will increase their dividends, right? Because those are the type of companies with safe dividends, and you will at least have a good average yield. And that's what I would do then. But you create kind of your own ETF here. That would be my suggestion.
Awesome. I kind of wish other brokers did that because I think that's a great feature.
Yeah. And I'm actually investing every month €250 in the Nobel 30 index for that similar reason. I get to get the best 30 stocks from Europe with that. And there's an average yield also of 3% or something more there. So it is also attractive from that point of view.
So I've been following your series that you were doing. I think you did the Dutch companies last,
Yeah.
where you pick companies from a certain country.
Hmm. Yeah.
I'm still waiting for you to do your next one, by the way. But I have put those into pies on Trading 212, and I put €50 a month into each of them. So I think I have two. You've done two. So
Yeah.
we see how they perform.
Good. This was the last question from the show. Guys, if you stuck so long with us again, I hope this really helped you. Our intention was also to help you calm down a little bit. Yeah, we are on different paths, different timelines of the journey, but we have both already experienced the pandemic crash, and we've earned a lot of money also by doubling down at a certain moment, right? And I remember that we both kept our heads quite cool. And I hope that this experience that we were sharing here today create some comfort for you as well as an investor. So, guys, keep your head cool. If you start worrying, remember, Dividend Talk is there. We've got you covered. Just replay this episode as a reminder. And for the rest, at least you have this weekend that the markets are closed. So don't think too much about money in the stock market. Enjoy the time with your family. That's what we invest for. Have a great day, everyone.
See you all later.